Welcome to The Explainer. Today we're putting Texas Pacific Land Corp through the ultimate valuation gauntlet. As an investment analyst, I'm going to walk you through a rigorous top-to-bottom stock analysis of what might be one of the most uniquely positioned companies out there. We're going to look at its core fundamentals and then run it straight through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham before capping it all off with some hard quantitative modeling and a discounted cash flow analysis. Right off the bat, let's look at this number. TPL commands a staggering $25.2 billion market cap. But here's the kicker. It operates with essentially zero debt. To put that into perspective, they carry roughly $15.5 million in total debt against nearly $248.6 million in cash. You know, in the capital-intensive world of energy and real estate, a balance sheet like that, it's basically a unicorn. So here is our roadmap for the gauntlet. We'll start with a quick company snapshot, apply the Buffett lens, move on to the Peter Lynch lens, hit it with the Benjamin Graham lens, run our DCF and quant models, and then bring it all together for a final synthesis and recommendation. Section 1. TPL Company Snapshot. What's absolutely fascinating here is TPL's origin story. This was essentially an accidental land trust formed way back in 1888 from a railway bankruptcy. They literally just existed to liquidate old railroad land. But then the 2010s fracking boom happened, and suddenly land they couldn't even give away a century ago turned into the most valuable oil real estate on the planet, prompting a reorganization into a standard C Corp in 2021. So how do they make their money today? Well, they generate massive revenues from three highly profitable streams: oil and gas royalties, water services, and surface land management. Here's the brilliant part. They are not an oil and gas producer. They don't drill the wells. They just own the surface and the royalty rates. So every single time someone wants to drill, build a road, lay a pipe, or use water in their part of the Permian Basin, TPL just sits back and collects a check. And that capital-light business model translates to this right here, a staggering 36.57% return on equity. Because they aren't sinking billions of dollars into heavy drilling equipment, their margins are just unbelievable. In fact, their recent EBITDA margins hit somewhere around 82%. Section 2. The Warren Buffett lens. Now, if we look at this through the eyes of the Oracle of Omaha, Buffett prioritizes a massive economic moat, highly consistent earnings, and excellent returns on capital without needing a mountain of debt to get there. He wants a business so inherently good that, well, anyone could run it. Running TPL through his checklist, they absolutely ace it qualitatively. Economic moat, they have an unbreakable land monopoly of around 890,000 acres right in the heart of the Permian. Manageable debt, we saw the cash pile. Pass. High ROE? Pass. Consistent earnings? Listen to this. Net income grew from $37 million in 2016 to $541 million trailing 12 months. It is objectively a wonderful business. But wait, we got to check the owner earnings, which is basically operating cash flow minus capital expenditures. And here we hit a slight, albeit temporary, wrinkle. Their trailing 12-month operating cash flow is a massive $603 million, but they recently shelled out $530 million in CapEx for a brand new desalination facility. That artificially depresses the TTM owner earnings down to just about $72 million. Now, if we normalize that using the 2022 and 2023 averages, owner earnings bounce back to a very healthy $420 million. Buffett would undoubtedly love the asset itself, but he always demands a margin of safety on the price. And as we'll soon see, that might be a deal breaker. Section 3. The Peter Lynch lens. Peter Lynch was big on categorizing companies, slow growers, stalwarts, fast growers, asset plays, just so you'd know what to expect. He also relentlessly checked the balance sheet, insider buying, and the PG ratio to ensure he wasn't overpaying for all that growth. Categorizing TPL is actually really interesting because it's a rare hybrid. It is textbook asset play because of those 894,000 acres and incredibly lucrative water rights. But at the exact same time, it's putting up a 20.82% trailing 12-month revenue growth rate, which means it is performing exactly like a classic fast grower. So let's run Lynch's specific quantitative checks. The balance sheet is pristine, and insider activity is looking really positive, especially with an executive from Horizon Kinetics, their largest shareholder, joining the board. But check out the PEG ratio. That's the PE ratio divided by the growth rate, where 1.0 is considered fair value. TPL has a PE of roughly 46.5, and when we divide that by the 20.8% growth rate, we get a PEG ratio of 2.23. Through a Lynch lens, That tells us the market has already fully priced in a massive chunk of future growth. So for him, at this exact price, it's probably a hold.
Section 4. The Benjamin Graham Lens.
Enter Benjamin Graham, the undisputed father of value investing. He demanded one primary thing: a strict margin of safety to protect the defensive investor. He looked for strong financial condition, earning stability, and a very moderate price-to-earnings and price-to-book multiple. Okay, this is where things get brutal. Let's run TPL's metrics through Graham's famous intrinsic value formula. We take the square root of 22.5, multiply that by the TTM EPS of $7.85, and then multiply that by the book value per share of $24.25. The result? An intrinsic value of just $65.44. And the current market price is hovering around $365? A strict Graham value investor wouldn't just pass on this, they'd run for the hills. There is absolutely zero margin of safety here by traditional hardline Graham standards.
Section 5. DCF and quantitative models.
Moving beyond the gurus, let's build our own models. First, we have to establish our base cash flows. As we touched on earlier, you can see this big temporary dip in the TTM free cash flow down to $84 million, all because of that massive $530 million desalination plant capex. But because the underlying day-to-day cash generation is still exceptionally strong, we're going to use a normalized base free cash flow of $450 million for our model. All right. Building out our base case discounted cash flow model, we forecast out 5 years using their 7.73% weighted average cost of capital as our discount rate. Let's be generous and assume a very solid 10% annual growth rate for those 5 years, followed by a perpetual terminal growth rate of 3%. What does it spit out? An implied fair value of roughly $150 to $180 per share. Even if we get really aggressive in our sensitivity analysis and tweak the WACC and terminal growth rates, it still doesn't come anywhere near bridging the gap to that current trading price of $365. Just to double-check our sanity, let's run a couple of alternative models. First, comparable multiples. TPL is trading at an enterprise value to EBITDA multiple of about 33.6 times. That is an astronomical premium compared to the rest of the energy sector. Second, let's do a reverse DCF. To mathematically justify that $365 share price today, the market is basically baking in the assumption that TPL will grow its free cash flow by over 20% every single year for an entire decade. Folks, that's pricing it like a hyper-growth AI tech stock, not a land and royalty business.
Section 6. Synthesis and final recommendation.
So let's bring it all together. Here is the stark reality. TPL is an objectively phenomenal business. Zero debt, unmatched margins, and a literal monopoly on some of the most critical energy land in the United States. But as any seasoned analyst knows, investing isn't just about finding a great company. It's about buying a great company at a great price. Our Buffett and Lynch analyses point to a hold for current owners because the asset quality is just so rare. But Graham and our DCF models, they are screaming sell or avoid for new money due to extreme overvaluation. And that brings us to our final verdict. If you are currently holding TPL with a low-cost basis, it earns a fundamental hold. This pristine asset is going to keep generating massive cash, and they are successfully expanding into water services and data centers. However, if you're holding new money or consider yourself a value seeker, it is a definitive sell or avoid at these current levels. The true fair value likely sits much closer to the $150 to $200 range, which is the territory where Buffett's criteria would finally trigger a buy. So, I leave you with this question. Are you really willing to pay software-level tech multiples for Texas dirt, or is it wiser to wait for the market to actually offer you a true margin of safety?